We finally have a clear victory in the fight against inflation. In August 2026, the latest data showed core prices dropping to their lowest level since early 2021. If you look at the Bureau of Labor Statistics data here, the bottom trend line tells the story. Core inflation, which excludes food and energy, slowed to 2.5% over the past year. Even more impressive, if you annualize the pace of the last 3 months, we're at 1.6%, which is actually below the Federal Reserve's target. This cooling trend removes the immediate pressure on the Federal Reserve to continue raising interest rates, finally providing some breathing room for the broader economy. But despite these wins, a sense of uneasy tension remains. The economy is sending back signals that don't seem to make sense. For instance, Americans are buying fewer homes than they were just a few months ago, yet the prices of those homes continue to climb. At the same time, we aren't seeing a massive wave of layoffs, but consumers have suddenly stopped spending money at the pump and in online checkout aisles. While the inflation crisis has receded, we've entered a transitionary phase where the housing and labor markets are moving in different directions at once. The housing market effectively hit a wall this summer. Existing home sales fell again in July to an annual rate of 4.06 million homes, the second consecutive monthly decline. Usually, when fewer people buy, prices start to drop. However, current home values are actually 1.2% higher than a year ago. A 1.9% dip in inventory explains this. There aren't enough homes for the people who want to buy. We are in a standoff. High mortgage rates have made new loans unaffordable for many buyers, while simultaneously discouraging current homeowners from selling and losing the low rates they already have. This has created a massive amount of pent-up demand. Lawrence Yun, chief economist for the National Association of Realtors, suggests that this stability is temporary and that the market will see a significant burst of activity once mortgage rates move closer to 6%. Turning to the consumer sector, retail sales dropped 0.6% in July. This pullback was especially visible in online retail, where sales fell even after the surge from June's Prime Day events. People still have their jobs, but they can see the difficulty for others to get hired, which changes their views on their own financial security. That fear is what's showing up at the cash register. As workers turn to gig work to stay afloat or watch their job searches stretch into months, they begin hoarding cash. American consumers are now prioritizing cash preservation over casual spending, a shift born from a deep-seated anxiety about their long-term prospects in a cooling job market. The Federal Reserve has managed to cool the engine of inflation without causing it to stall, but the transition has created a delicate balance for the labor and retail sectors. For those who already own a home, this cooling period has a silver lining. Even in a stagnant market, a 5% appreciation on a $500,000 home still adds $25,000 to a family's net worth. We are currently in a period of waiting. Everyday consumers and the nation's top policymakers are both watching the same data points, waiting for the signal that tells them which way the economy will tip next. To see where we're headed, watch the housing starts and building permit reports coming out next week, along with the latest update on continuing jobless claims. In the meantime, if you're looking for a way to enjoy the season while keeping your spending in check, there's a simple project you can tackle in the kitchen. Plums are in season and perfect for a quick homemade cornbread. Just slice 4 to 6 plums, toss them in sugar, and arrange them over a simple batter of cornmeal, honey, and vanilla. Bake it for 30 minutes in a cast iron skillet for a wholesome, seasonal treat that beats anything you can find in an online store.